If you've ever bought a car in America, there's a real chance you overpaid by thousands of dollars without even realizing it. And it usually doesn't happen because the sticker price was too high. It happens because of how the deal is structured inside the finance office. Once you sit down and start talking about monthly payments instead of total cost, the entire negotiation shifts in the dealer's favor because they know most buyers think in terms of, "Can I afford this per month?" instead of, "What is this car actually going to cost me over the life of the loan?" And that's where the hidden $5,000 starts to build quietly in the background, piece by piece, without setting off any alarms in your mind. First, they stretch the loan term. Instead of 60 months, they move you to 72 or even 84 months, which instantly lowers the monthly payment and makes the number feel comfortable. But what they don't emphasize is that you're now paying interest for 1 to 2 extra years, and that additional time alone can add thousands in interest charges even if the rate stays the same. Then comes the APR adjustment. Maybe you qualified for 6.1%, but the dealer marks it up to 7.4% because many dealerships are allowed to increase the rate and keep the difference as profit. And since most buyers don't know the exact rate they were approved for by the bank, that tiny percentage bump feels invisible. Yet, over a long loan term, it can quietly cost you $1,500 to $2,500 more. Next, they introduce add-ons during the excitement phase of the purchase. Extended warranties, gap insurance, paint protection, tire and wheel coverage, VIN etching, service contracts, and other peace-of-mind products. And none of these are necessarily bad on their own, but the key is how they're presented. Instead of showing you the total cost up front, they say something like, "It's only $18 more a month," and psychologically, $18 feels small compared to the total payment. So you agree without calculating that $18 times 72 months is over $1,200. And if you stack 3 or 4 of those add-ons together, you've just added another $3,000 to $4,000 to your loan without feeling the pain. On top of that, there's the trade-in strategy. If you owe money on your old car, they may roll that negative equity into your new loan, meaning you're now financing debt from your previous vehicle along with the new one. And because everything is blended into a single monthly payment, it becomes nearly impossible to see how much of that payment is actually going towards the new car versus old debt. Dealers also use payment packing, which is when they quote you a monthly payment that's higher than what the actual financing requires, leaving room to slip in products later while still telling you they met your budget. And since most buyers focus only on staying under a certain monthly number, they don't question the breakdown of how that number was built. Another tactic involves presenting multiple paperwork sheets with slightly different structures, creating confusion and urgency, so you feel pressure to sign quickly before the deal expires. And in that emotional state, after spending hours at the dealership, test driving, negotiating, waiting, you're mentally exhausted, which makes you far more likely to accept terms without analyzing every detail line by line. The environment itself is designed for this. Long waits, friendly conversations, reassurances that this is standard, and subtle framing that makes questioning the numbers feel awkward. And by the time you're handed the final contract, you're focused on getting the keys and driving home, not on recalculating total financed amount, total interest paid, and the true out-the-door cost. What makes this system so powerful is that nothing feels like a scam in the moment. Every individual step sounds reasonable. Lower payment, longer term, extra protection, easy approval. But when you zoom out and look at the total financial picture, that $30,000 car might now cost you $35,000 or even $38,000 over time. And because the increase is distributed across dozens of small adjustments rather than one obvious markup, your brain never registers a major loss. This is why the smartest buyers don't negotiate based on monthly payment at all. They negotiate the out-the-door price first, secure financing from a bank or credit union before walking into the dealership, know their exact approved interest rate, refuse to discuss payment until the full purchase price is locked in writing, and review every single line in the finance contract, especially the total amount financed and total of payment sections, because those two numbers reveal the real story. If you want to protect yourself, always ask for the full amortization breakdown, calculate the total interest over the life of the loan, compare financing offers independently, and remember that any product described as only a few dollars more per month should immediately be converted into total cost over the entire term before you agree to it. When you shift your focus from monthly comfort to total financial impact, the leverage flips back to you, and suddenly the hidden $5,000 becomes visible before you ever sign. The dealership's power comes from controlling the structure of the deal and the pace of the conversation. But your power comes from slowing everything down, separating price from financing, and making decisions based on total dollars instead of monthly emotion. Because at the end of the day, the car you drive home may look the same, but the difference between a rushed, payment-focused decision and a calculated, price-focused strategy can mean thousands of dollars saved or lost over the next 5 to 7 years of your financial life. And here's what most people never think about: depreciation. The moment you drive that car off the lot, it can lose 10% to 20% of its value instantly. Yet you're financing not just the car's current value, but often taxes, fees, add-ons, and even rolled-over debt, which means from day one you could owe more than the car is actually worth. That's called being upside down on your loan, and it becomes extremely dangerous if you need to sell the car early, trade it in, or if it gets totaled in an accident. Now you're stuck either paying the difference out of pocket or rolling that negative equity into your next vehicle, starting the entire cycle all over again. This is how people stay trapped in car payments for decades without realizing how much wealth it's draining from them. On top of that, dealers often shift your attention away from the out-the-door price by using Foursquare worksheets, blending trade-in value, down payment, monthly payment, and total price into one confusing layout, making it nearly impossible to see where the real numbers are moving. You might feel like you negotiated $2,000 off the sticker price, but if they reduced your trade-in offer by $2,000 at the same time, you didn't actually gain anything. It just feels like you did. That emotional win is part of the strategy. Timing pressure also plays a role. You'll hear phrases like, "This deal is only good today," or "Someone else is looking at this car," creating artificial urgency so you make decisions quickly instead of analytically. The longer you sit in that finance chair, the more mentally fatigued you become, and decision fatigue makes people far more likely to accept terms just to end the process. By the time the paperwork comes out, you're tired, excited, and ready to leave, which is the worst possible mental state for signing a long-term financial contract. And let's talk about interest over time. On a 72 or 84-month loan, you're paying more interest in the early years than principal, meaning if you try to sell the car after 2 or 3 years, you may barely have made a dent in what you owe. That's why dealerships love long-term financing. It lowers the monthly payment enough to close the sale while maximizing interest revenue over time. None of this is illegal, and that's what makes it powerful. It's not about breaking the law, it's about structuring the deal in a way that benefits the lender and the dealership more than you. The only way to win is to flip the script. Secure pre-approval from a credit union before stepping onto the lot. Know your exact interest rate. Negotiate the total vehicle price separately from financing. Refuse to discuss monthly payment until the purchase price is finalized. Decline add-ons unless you've researched them beforehand and understand their full cost. Ask for the total of payments number and calculate how much interest you're paying in total dollars, not percentages. When you slow the process down and force transparency into every step, the hidden profit centers start to disappear. And here's the truth. Dealerships expect informed buyers. They build margin for negotiation into every deal. The difference between someone who walks out overpaying by $5,000 and someone who saves that money often comes down to preparation, patience, and the willingness to say no. Because, at the end of the day, the real trap isn't the car itself, it's focusing on what feels affordable today instead of what will cost you over the next 7 years. And once you understand how the structure works, you stop being a passenger in the deal and start being the one in control. There's also something else happening behind the scenes that most buyers completely overlook: back-end incentives and reserve profit. When a dealership arranges financing for you, the bank often gives them what's called a dealer reserve, which is essentially a commission for originating the loan. That means the dealership can make money not just from selling the car, but from selling the loan itself. If they mark up your interest rate above what the bank approved you for, they can keep part of that difference. So even if you negotiated the car's price aggressively, they still have a second opportunity to earn thousands through financing. And because most buyers don't shop their interest rates separately, they assume whatever rate they're offered is the best they qualify for. In reality, walking in with pre-approved financing instantly removes that leverage from the dealership and forces them to compete for your loan instead of quietly profiting from it. Then there's the psychology of affordability framing. When you hear a number like $499 per month, your brain compares it to your current monthly bills. It doesn't immediately calculate $499 times 72 months plus interest. That's over $35,000 paid over time, but your brain doesn't feel $35,000. It feels $499. Dealerships understand this deeply. That's why conversations are steered toward monthly comfort instead of total obligation. It's the same reason subscription businesses thrive. Small recurring payments feel manageable, even when the long-term cost is massive. Over 6 or 7 years, that manageable payment can quietly drain tens of thousands of dollars that could have been invested, saved, or used to eliminate higher interest debt. Another hidden cost comes from add-on products being financed instead of paid up front. When you roll an extended warranty or protection package into your loan, you're not just paying the price of that product, you're paying interest on it for years. A $2,000 warranty financed at 7% over 72 months doesn't cost $2,000 anymore. It costs closer to $2,500 or more by the time interest is included. Multiply that by multiple add-ons, and suddenly the hidden markup grows larger than most people's emergency fund. And here's the uncomfortable truth. Many of these products have extremely high profit margins for the dealership, sometimes 50% or more. That's why the finance manager presents them with such confidence and urgency. There's also the tactic of stretching negotiation across multiple variables at once. Instead of negotiating just the vehicle price, you're negotiating trade-in value, interest rate, loan term, down payment, and monthly payment all at the same time. When too many numbers move at once, clarity disappears. You might win on one variable and lose on another without realizing it. For example, they agree to increase your trade-in value by $1,000, but extend your loan by 12 months, which ends up costing you $1,800 in additional interest. On paper, you feel like you gained something. In reality, the structure shifted against you. And let's not ignore the emotional factor of identity. Cars in America aren't just transportation, they're tied to lifestyle, status, and freedom. When you find a car you love, your decision-making becomes emotional long before it becomes financial. The dealership knows that once you picture yourself driving it home, your resistance drops. That emotional attachment makes you more flexible on terms, more open to add-ons, and less likely to walk away. Walking away is your strongest negotiating power, yet it's the hardest thing to do once you've mentally claimed the car. So, how do you flip the advantage? First, separate the transaction into steps. Negotiate the purchase price of the vehicle only. Get that number in writing. Second, secure outside financing before you step into the dealership so you know exactly what interest rate you qualify for. Third, calculate the total cost of ownership, not just the loan, but insurance, maintenance, fuel, registration, and depreciation. Fourth, never decide inside the dealership under time pressure. If needed, leave and review the numbers calmly at home. A legitimate deal will still be there tomorrow. And finally, understand that the goal is not to win the negotiation emotionally. It's to minimize the total dollars leaving your pocket over the life of the loan. Because the difference between a smart car purchase and an expensive financial mistake often isn't intelligence, it's awareness. Once you understand that dealerships optimize for monthly payments while smart buyers optimize for total cost, you start seeing the entire structure differently. That hidden $5,000 isn't magic. It's built from small adjustments, stretched timelines, slight rate increases, and bundled extras. And the moment you stop focusing on what feels affordable today and start focusing on what it truly costs tomorrow, you take back control of the deal and keep thousands of dollars where they belong, in your own bank account. If this saved you from overpaying on your next car, hit the like button so more people see this. And before you step into a dealership again, make sure you're subscribed, because the next mistake could cost you even more.